Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We're not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is May 12th, morning of May 12th, and good morning, Andy Lebow.
Good morning, Jim Colburn.
I think we should start right from the get-go. Let's talk about Russia. The consensus number seems to be that when it's all said and done, 3 million barrels of oil will be taken off the market. Can you give us an update on where you are on Russian oil exports and products?
Yeah, it's 3 million barrels a day. The IEA today, this morning came out with their own change really in what they thought on Russian production. Originally, they had thought that by the end of April it would be down 1.5 million barrels a day, and now they're saying it's probably closer to 1 million barrels a day. They think that will increase to 2 million barrels a day as we get through the second quarter and sometime later in the second quarter or into the third quarter, depending on if there's an EU embargo or not. Russian production will be down by 3 million barrels a day. So I think that 3 million barrels a day number is still good, but it looks like it's gonna take some time. And the EIA had them down by 2 million barrels a day later, second half of this year. And OPEC, whose report came out also this morning, has Russian production down just 1 million barrels a day. But of course, let's remember that Russia is part of the OPEC Plus, part of the OPEC Plus cartel. So some of those numbers may not be 100% accurate. Let's put it that way, Jim, because I think 1 million barrels a day is too low, actually, for the rest of the year. Because the EU it looks like they're moving towards some kind of embargo. That there's still some negotiating taking place, but I think our base case actually has a European embargo sometime later in the second quarter, and I think the IEA is the same. Is looking at the same things.
Well, there's also some of the trading companies aren't willing to move Russian barrels as well. So it's not just coming from the governments; it's coming from the private sector as well.
Right. There's self-sanctioning and the governments. It's interesting that the IEA actually said that Russian crude oil exports increased in April as some of these contracts come to an end, and Russia wants to get all they can out of the country to get as much revenue as possible, as they too can. They too could read the tea leaves on what's happening with the EU. So they actually had high exports in April, but beginning in May, those are going to be cut pretty dramatically. We're almost in mid-May, and into June will be cut further. So I think the IEA numbers are good, and as I said, that's pretty much what we've been working with.
And that's what's in the market as well.
Yeah, I think that's what's in the market as well. Yeah, I mean, probably anywhere between the 2 and 3 million barrel a day mark. But I think most analysts and traders are probably closer to 3 million barrels a day.
And let's just take these one by one. Let's move over to China. What is your update on the demand for oil and products from China, given their
Well, China petroleum demand at the beginning of the year was, we had them up like 0.6, which I think was close to the consensus, some higher, some lower, growth in demand owing to the lockdowns and their owing to the lockdowns as well as the slowing of manufacturing, distribution, and exports. We've pretty much cut that to unchanged to up 0.2. So, loss of at least 0.4 million barrels a day on growth for this next year. Now there is a stimulus package coming. Maybe that will help. But Jim, it wouldn't surprise me to see China be unchanged, maybe even lower than than last year's demand.
I mean, the uncertainty is when do they come out of lockout,
Right,
right?
right,
So
and how
nobody
hard they can come out of lockdown on the demand side.
lockdown. Yeah. Yep. Yeah. It's just we are you more confident with what's going to happen with Russian oil than you are with China demand, or are they both lots of
I think they're both. I think they're both covered with uncertainty. I think they're both. The numbers are moving targets. I'm pretty confident on the. China may. Maybe it'll come up a couple of 100,000 barrels a day. That. Your delta isn't as great there. I don't think it's going to end up being up. Demand for this whole year being up 1 million barrels a day, anything like that. The Russian number, of course, is there's a geopolitical factor with what happens with the on the EU, so that number can really swing, and also what happens to Asian buyers. Obviously, China is not their import numbers are way down, so they're not taking that extra Russian that well they're taking some, of course, but not anywhere near probably what the Russians had hoped.
And I think the EIA says something. They say we're in a heightened period of uncertainty, which I think they say every month since beginning of COVID. They've been saying that. Yeah, it's
Yeah,
tough being an analyst these days.
it is. I think these, as we've been saying since the beginning of COVID, these balances are kind of hard to, get right, or even close to it. I think we've been doing our best. We've been updating them, you know, more than more than a few times a quarter.
Right.
Or usually I would update them monthly, or you know, if there were big changes. But now it's just about every other day, really.
I know. It's
It's
unbelievable.
really, it
Um,
really is unbelievable.
so we probably should talk about product demand and prices. The cracks, the prices themselves are going wild. The cracks, I guess, are at record levels. You want to take gasoline first?
Well, yeah, gasoline. If you look at the last EIA weekly report, the gasoline has now dipped below. Inventories have now dipped below the 5-year pre-pandemic, the 2015 to 2019 levels. And you look at what's been going on in the front of the curve. We're at a big backwardation now. So that's indicative of a tight supply, and certainly stocks on the East Coast have continued to decline over the last few weeks, despite the fact that pump prices are record. Demand for gasoline is actually it's okay. Well, it's not that great. I mean, demand for gasoline is The 4-week average is 8.8 million barrels a day. If you look at that 2015 to 2019 number, Jim,
Mhm.
that's 9.3 million barrels a day. So because of the pandemic, or one of the reasons, we've lost 500,000 barrels a day of gasoline demand. Now, you had some interesting numbers on the gasoline demand
Yeah.
momentum, which seems to be slowing here.
Yeah, I looked at the the weekly numbers. This came out yesterday, and I looked at all the demand components, and it looks like momentum is slowing down, and price rations use is what the saying is. And if you look at gasoline, the 4-week average is 8.8, as you said. That's down 1.4% from last year, but the year-to-date number, so that's actually up 3.1% from last year. So clearly a loss of momentum. And again, that's not picking up any seasonality. That's comparing year on year. And we have the same thing going on in a lot of the categories from that weekly report. Distillate up 2.1 year to date, but 4-week average down 5.5%. And this is year on year. The other one I would mention is jet fuel. Jet fuel's up year to date, up 28%, and 4-week average up 27%. So that's maintaining its strength from last year. But gasoline and distillate looks like a loss of momentum.
And that's not surprising, given that we have record pump prices on both. I mean, diesel prices are through the roof.
So if a refiner came to you and said, we want to hedge second half cracks, what would you say to them?
I would say, yeah, I would look at hedging second half cracks for sure. Now, the cracks have come off. At least the front just came off in the last 2 days. They were closer. They were like mid 60s, which is an incredible number for diesel cracks in the front of the curve. The back is still pretty healthy. So if a refiner came to me and said, would you be looking at hedging these cracks? I would say absolutely. But given the fact that I think there's still some upside here on diesel, I wouldn't be hedging their entire run. In fact, I'd probably be looking at hedging maybe, I think 10 to 20% is the right number, Jim. I don't know if you agree with that.
Yeah, I
But
was coming in around 10%. I mean, we're kind of, these cracks have just exploded, and we learned from the nickel market that when you're hedging, you inject some cash flow issues. So if you sell far out along the curve and the hedge goes against you, you have to come up with margin money, and you don't get the benefit of those higher prices because you're not, you're selling the amount of stuff you're hedging more barrels than product that you're selling every day. So you get this cash flow problem, and we saw that in extreme in nickel, but it happens in other markets as well. So I was saying little with the ability. I mean, this thing's gone ballistic already. Continue to go. I would say 10%, and then kind of ratchet it in there, a little layered in there, but be very conservative hedging. And the other part is, like you said, it might not be over, but it doesn't, just because it doesn't keep making new highs doesn't mean it's going to collapse either. So I don't know. You probably these cracks will probably be good for a while. I mean,
yeah, I think so. I mean, you look at Pad 1 diesel stocks; they're at the lowest since 1990, and maybe before that. I don't have the data for before 1990, but the question is, where is the resupply coming from? A lot of the Gulf Coast diesel is moving to Europe and South America. In Pad 1, we have lost a significant amount of refinery capacity. So it's gonna have to come from Gulf Coast. Refiners are gonna ramp it up some more. Any spare capacity of the East Coast is gonna be ramped up. And Europe is, they've certainly got their own issues, and imports of diesel have been distillates are awfully low right now. They may pick up some. I mean, the arb is open, but it's a question of getting getting boats and insurance, et cetera, et cetera. And the Russian exports are for diesel is 1 million barrels a day, so that's a big loss for the global market. What has to happen is product has to move from east to west. We've got to see more exports from Asia into Europe, help to fill Europe, and then maybe get the overflow here, which, that's going to take time. So there's certainly a window open for these cracks to remain pretty strong. But you don't want to miss it either, right?
Yeah.
You don't want to miss it either.
Well, that's right. You're locking in incredible numbers right now by hedging.
Right.
Yeah.
Right.
It's,
Yeah. You got to get some off.
yeah. And then, you never want to hedge too much because, what if your refinery goes down? then you and the, the markets, you're losing money on your hedges and you can't make it up with products. So that's a problem too. You'd love to be buying puts, but there's no viable put market in cracks. We traded it back in the day. Like I remember 2001, people were trading some crack options, but it tended to be one flow, like put buyers and call sellers, and the market makers I don't think felt comfortable having, not having two-way paper flow, buyers and sellers coming in. So there were less and less market makers and got less and less interest. So it hasn't been a viable market. I wonder if you could buy a put on sort of a bunch of refiners. You buy puts on their stocks, but that you couldn't buy. If you're a refiner, you can't buy. It doesn't make sense to buy puts on your own stock. But I'm just thinking about how you would hedge this by buying puts, which would be the best way, I think, because then if the market roars up, you're okay. You locked in a worst case price, and so.
But the worst case price is pretty awesome.
It's pretty awesome. That's right. So
it's like
it's like oil
if
producers.
the market goes down, at least you got some of that. Of course, there's also the question of what your shareholders want you to do.
Yes.
Whether or not they're comfortable with you taking some taking some risk off the table on your refinery run. And let's move over to gasoline. We're heading into the season. As I mentioned, we're now below the below the 5-year average by 10 million barrels. And given the backwardation in gasoline, this is indicative that things are tightening up. So do you hedge some of your gasoline run as well? These numbers are good for gasoline, all down the, a $50 crack in the front for gasoline. Refiners used to be ecstatic. $20 cracks, $20 gasoline cracks were awesome. So my answer would be, yeah, I'd probably take a look at, hedging some of that too. Maybe not as much as the diesel, but yeah.
The 3-2-1s are back.
The 3-2-1s are back. Jim, they're $50.
I know, it's unbelievable.
Crazy.
Yeah, we had a Zoom cast with some of our refiner friends, and we asked them, what part of the oil business would you like to be in right now? And they all said, we'd like to be refiners.
Right.
Yeah.
Right.
So,
which if you are always the answer, right?
What's that?
That's not always the answer.
No.
Usually it's like, oh, we don't even want to be in this business, but if we had to, I guess
exactly. Yeah, you're losing money per barrel, but you're going to make it up on volume, that kind of thing.
Right.
Anyway, going forward, if you are a refiner, are you making more distillate during the gas season than you normally do?
Yeah, absolutely. I mean, the crack told you to make more to make more diesel, and that's another bullish factor for gasoline. You'd expect that the yields at least in this country, is going to be, switched to diesel, and at the expense of gasoline. So if we do have any kind of booming gas demand this summer, it could be an issue. Now I'm looking at the EIA's view for gasoline demand this summer, let's say Q2 and Q3. They're not looking for all that much growth. They last year Q2 and Q3 were about 9.1 million barrels a day, and this year they're looking at 9.12, so almost no growth from last year.
Hmm.
And that could be a price effect. Maybe it's an income effect, an inflation effect. I'm not sure, but that roaring gasoline season may not come completely to pass this year.
Yeah, it's interesting. You mentioning inflation. The economists are getting whacked a little bit for looking at the core rates. As people were saying, wait a second, you're taking food and energy out of the CPI,
Yeah,
and
right.
that's our big expense.
Right. Should we take that out of our right,
Yeah,
out of our pockets, right? Should we not eat or drive?
yeah. I don't understand that when they talk about the real price of oil and they use the CPI to sort of get in $1960 or 70 $80, whatever they talk about. It's a big component of oil in that CPI, so you're kind of dividing it by itself. And there must be a better way to look at that. But anyway, still a lot to talk about, Andy. So those are kind of some major issues. Let's go back to talk about your stock levels. I think a lot of people had builds in global stock levels for the second half of the year, and now you get more of a balanced look to the market. And you had a surplus, but why don't you update us on what your thinking is with global stock levels?
Yeah, I had I had a surplus, which I've lowered just a little bit, but for 2022, I see a global stock build of only of 330,000 barrels a day, Jim, which is really balanced. The question, of course, is will the loss of 3 million barrels a day be covered? And the answer is yes, it will be. OPEC production is going to be on the rise. Non-OPEC production, ex-Russia, is going to be on the rise, and we're getting SPR barrels. Plus, there's the loss of demand. So we have demand down. Demand from the beginning of the year, we've marked it down by 1.3 million barrels a day, which is exactly what the IEA did.
Uh,
So mine was done before the IEA, Jim. And I think you look at these balances, and yeah, we're tightly balanced, which is leaves you to err on either side. If you look at the EIA numbers, which came out, the short-term energy outlook, they too have a build of 300,000. Just look at that now. So they're, again, very tightly balanced, and OPEC is basically unchanged for the year. Second quarter looks like it's to me, I've got a build of 600,000, and the other guys are all around, OPEC and the EIA are up around 700,000. So it looks like second quarter we should be seeing some modest stock builds here, which will certainly help rebuild inventories somewhat. We're still way too low.
right.
But you look at these builds. I think it's hard, and we've been saying this, I know, in our monthly reports, and also on these podcasts. To me, it's hard to see the market really, unless something changes dramatically. I just don't see the market exploding on the upside. we've been in a broad trading range over the last few weeks between, let's say 115 and 92, a big trading range. And then just in the last 6 days, we've been between 111 and 92. But I kind of think that's the range for now. And I'd be more bearish, slightly more bearish than bullish.
Well,
But
it's interesting you bring up trading ranges. That'll introduce me to just a little options chat. But I think was it the EIA they're saying Brent range $42 in March, $17 in April, and we saw that in volatilities in March on the high price of was it March 8th or 9th, something like that. The high price was we got over 100% implied vol in the front month. Second month was only up around 75%, I believe, and now we've been going between 50 and 60. June expires on the 17th pretty soon. It's at 53%, just sold off yesterday, and July is at 54.6. So they're down, they're up from, I still use a long-term average around 33%. So they're up from that, but way down from last month, and kind of it's saying there's still a lot going on in this marketplace, but the actual price movements are less than what they were last month, much calmer. The call volume, we still see, so the volumes also collapsed. In April, WTI options trade around 95,000 a day, and that was down 44% from March. So we talked about that before, where for a year people were gearing up for this rally in crude, and then they get this Russian invasion, and it was a lot massive profit taking and liquidation. And we do see flurries of bullish activity when prices dip. We'll see like a big call day, and but overall, even in April, the volume seemed to be subdued, and we've lost a lot of players. I know, probably temporarily, but because of as we've been talking so far, the uncertainty in the marketplace, we've reached a level of uncertainty to reduce the trading, I guess, is what I'm trying to say here. Our famous DEES 2200 call still is number one, as 51,000, but if I recall, that was up, or that open interest was up to 75,000. So that's been trading. It hasn't been the top traded option, but it has been somebody's been liquidating positions in there. And then in Brent, the biggest call open interest is the DEES 150 call, about 43,000. They also have a DEES 55 put, was around 42,000, but I think that's a lot of the Mexican hedge is going into the Brent market, so that might be part of that. I think it was from a long time ago, put on a long time ago. So, but other than that, again, the market, the option market subdued, and we're just I guess I try to look at the Gulf War, where the volatility got over 100% on a price move up. It was both wartime. And what happened, what we started to see was the market would churn around, move sideways, still have some big trading days, like price moves, but overall it wasn't gaining any ground. And you'd see the people who had bought options to play the volatility, as that option became front month, or became just maybe a couple of weeks to go, they'd start liquidating it and go out and buy something along the curve. So they wanted to stay long options, but they didn't want to get hit with time decay. So you start to see implied vol in the front month collapse, like 2 weeks to go on the second month. And we haven't seen that yet, but yesterday's settlements, June settled under July, 53%, versus 54.6. So maybe if we keep churning this market, going forward, we'll see more of that kind of activity. So basically vol staying around 50%, but as we get closer to expiration, the front month collapses maybe 2.5 weeks out. Anyway, so what else we want to talk about, Andy? We covered a lot here.
Here's a question. So we're talking about ranges and and vol coming off. Now, would you sell those ranges? Would you sell a call in let's say a 120.90? I don't even know what value that would be, but would you sell that type of trading range?
Well, my approach is always to look for markets that are low volatility moving to high volatility. I think that's the way to go. This one, unless it's extreme, and I would say if you do that, just do it very lightly. In terms of your portfolio trades, it's probably gonna be okay, but you won't. And then it's not only a risk reward, but do you want to sleep at night? That kind of thing. Do you want to? You're probably going to focus on that more than what it's worth. So yeah, but it's probably.
I totally agree. I just wanted to lay you up with that one.
Yeah, no, it's not. Listen, the way I learned options, I saw, I was a broker for Merrill Lynch, and I had these two speculative clients, and we were very bullish. This is back in the 80s, mid 80s, and we were bullish the stock market, very bullish. And one guy buys futures, and the other guy buys like a handful of out of the money calls. And the first move the market made was dipping lower, stopped the futures guy out, and the guy with the calls doesn't budge. And the market turns around and goes higher. And for like 3 days, I tried to get this guy back into his futures position, but he wouldn't budge because he didn't want to buy above where he sold it. It was this psychological barrier. And meanwhile, the stock market went up like for the next couple of weeks, and this guy, the calls went deep in the money, and we started selling. We picked the top, and we sold 5 futures against the market where it was. And in a couple of days, it came down, and we bought them back, and it went up again. And we did this like 3 or 4 times, and the guy was, he was ecstatic. He said, "I never made all this money." Anyway, he never made this money in his life, but it was my first sort of entree into options, and so it's my bias, and I think it's served me well, is to be on the long side of buying of options, not the sell side. But
which I know because you've been in all the presentations and all the teaching that you've done on options. That really has been a theme of yours. That buying options is in many ways better than selling options.
Yes, so. In markets, it's never 100%. I mean, a lot of the oil companies, they have assets they can sell calls against, or but they also have optionality in their assets, in their daily business, the way they conduct business. So they're basically long options just by the nature of the business, and so to monetize them, sometimes you sell options, or you do a delta hedging technique that you trade your gamma basically against it. So it's kind of like monetizing a long option, and so I'm not dogmatic on it. I'm just saying it's my bias. I'd rather be a buyer of options than a seller.
Right.
Especially in this world. Holy cow.
Oh,
it's like we can't go to kids anymore and say, "Oh, when I was a kid," you guys don't know anything. It's I used to. Yep.
Yeah, I think a lot of investors are now being confronted with a lot of new investors are now being confronted with worlds that they just had no idea about inflation being certainly one of them. I mean, we're talking about a generation type inflationary move. And of course, what's gone on in the oil market in the last since the pandemic is historical. So
Yeah. And that there's evil in the world.
yeah, and
You know.
that there's evil in the world.
Yeah. So
Which we unfortunately, as just following the oil market have learned too often, I'm afraid.
and Andy, we talk anything that we missed that you want to
No,
talk
I
about?
think we did a pretty good job covering. I'm sure that we've missed plenty, but
Yeah.
I think we've covered a lot of ground here.
You don't want to talk about Mars spreads? No.
I
That's
wouldn't
okay.
mind talking about the Boston Celtics, but
Oh
I
God.
don't think
Okay,
think
with that,
that's
Andy, let's wrap this up.
I
Yeah,
think it's a wrap up. Yeah.
just the Celtics just lost game 5 to the Milwaukee Bucks. I'm a big Celtic fan, but well, Andy's a Knick fan. That's can't even bring
Right.
that
I
up.
have nothing to talk about.
Yeah.
All I'm living for is rooting against the Celtics. So it's
Sports,
like many Knicks fans.
sports hate.
Yeah.
Very good. Okay, Andy, we'll talk to you next. I'll talk to you sooner than next month, but our next podcast is scheduled for next month. We try to do them once a month. Don't always, based on our schedules, we can't always get to it, but I'm sure by next month there'll be lots to talk about in the energy markets.
Yeah. Let me just conclude. You can find us. Jim's on LinkedIn. As am I. If you want to get a hold of me, I'm at a Lebow at commodityresearchgroup.com. And we also have a website, and we're both available for consulting. Jim is one of the great option teachers ever. I mean, I've sat through many of the lectures, and I still learn something each lecture. And he too is available for advice and consulting on options and option strategy.
All right, Andy, talk to you next month.